Ladies and gentlemen, welcome back. It's a full moon today, I believe. I actually just made that up. I don't know what it is, but it must be because I'm up late tonight and I thought I'd smash out a video. I wanted to do it because we have, a price action coming tomorrow. I looked into it yesterday with some consolidation on short-term charts. I do expect some price action very, very soon on the Bitcoin chart, some interesting price action. And so I wanted to get out a Q&A video today. Because if we're occupied by the price updates tomorrow, we can't get into the Q&A, so we've got to do it tonight, right? I left a post on my YouTube community page. I said, ask me a question about the market that you would like to see answered in an upcoming video, and you guys left a bunch of questions, right? Dozens of questions there. I've picked out, let's see how many I picked out. About 10 of them, let's say, 8, 9, 10 of them. And I'm going to be answering those today. So go check out the timestamps down below. And you can see the timestamps. I'll have them in the pinned comment and description. The questions I've answered and at what part of the video I answer those questions. You can take and pick and choose which questions you want to see the answers to. Otherwise, just watch the whole thing. There's useful content here. I've handpicked these questions. You guys left a bunch of them. I picked out which ones are the best ones, which ones I think will be the most useful, and which ones I think I have the best answers for. And so it should be an interesting video. I do these about every 2 weeks, so keep an eye out for the next one as well. Guys, this will be very, very insightful. Before we get into it, check out the BitConnect and BingX exchanges. These are the exchanges I advertise on this YouTube channel with a 15% trading fee discount available with my referral links down below. So all you got to do is sign up with that referral link down below in the description or pinned comment, and you'll get a 15% trading fee discount to these very good exchanges. I've handpicked them myself. They are both global non-KYC. Okay, so you can sign up from anywhere in the world. Check those out if you're interested. Let's get into the questions. First question. A few people are talking about money printing. I always thought that it was done by the central banks, but now I read on Wikipedia that it's actually done by commercial banks when they allow loans for consumers. Which is it and how is it actually done? Okay, so a brief explanation of how money printing occurs. Money printing, right? The Federal Reserve is going to print money. It's going to pump the markets. The money printers, all of that is a little bit misleading. It's how it used to be, okay, before the digital revolution, before the digital age. Yes, the money was literally printed, right? Literally in a factory, printed by a printing press and shipped out. Okay, that's how it worked back in the day. But now a lot of the money is actually digital, okay? It doesn't exist in any real form. And so the way money is created now is via bank loans. So you were correct in what you read on Wikipedia. The Federal Reserve, in a basic sense, the Federal Reserve sets the conditions through which the commercial banks can lend, right? The capacity in which they can lend, the frequency in which they can lend, that is all set by things like interest rates, by stances the Federal Reserve has, like being in a quantitative easing phase or being in a quantitative tightening phase, okay? These things determine basically how much the commercial banks can loan, at what rates, etc., right? And when the commercial bank has a customer who comes to them and says, hey, look, I want a loan for $10,000, the commercial bank is not actually going into the safe or going into their reserves and picking up 10 grand and giving it to the consumer. No. They're creating a new $10,000, right? The money you receive from a bank in a loan is not the money of the bank. It's fresh money. It's fresh currency that was created. All right. So you taking a loan, virtually all of the money you're receiving in that loan most of the time is new money that did not exist before you took the loan. So yes, money is created through debt. Debt is given to people via the commercial banks, and the frequency and the quantity of debt that the commercial banks can give is essentially determined by the Federal Reserve. So that's a quick little explanation, a good way to understand how money printing actually works, quantitative easing, quantitative tightening. And just to reiterate, I suppose, from what you may have heard before, what I've said before on this YouTube channel, when you enter a period of quantitative easing, you're going to have a lot of money flow into assets. When people are taking loans, they generally do it to put it right into assets, okay? You take a loan, what do you do with it? You buy a house, okay? So when money is created on any massive scale, it's created by companies looking to expand the company. Stock valuations go up. It's taken by people who can buy homes. All of the money, essentially, the vast majority of it, is going into assets. And so if you own assets in a period of quantitative easing, right, you're going to have the assets rise in value. And this is why quantitative easing, to go into something a little bit different, is one of the biggest causes of wealth inequality. Inflation causes wealth inequality more than anything else, because in order for inflation to occur, you need to have money printing occurring. And if money printing occurs, that is synonymous with assets rising in value. And who owns the assets? Well, the people with money already own the assets, and the people who don't have money don't own assets, and so they get left behind. But all of this is to say, quantitative easing is good for assets. Quantitative tightening is generally bad for assets. It's much more nuanced than that, but I hope I explained actually how it works mechanically as well. So that was a bit of a long-winded explanation there, but it also gives you the basis through which you can go further into that with that understanding. So hopefully that helped you. Right, next question. How do we tell we are near a top and sell before it's too late? There's two kind of scenarios here. One of them is very, very easy. One of them is very, very difficult. So first scenario is we top out as per regular 4-year cycle, in which case finding the top is so easy. All we need to do is look at the bloody calendar, essentially, right? The 4-year cycle, very strong date range trend on Bitcoin, supported by things outside of Bitcoin, like the presidential cycle theory, like the 18.6-year real estate economic cycle theory. These cycles all work together and they all give the same kind of prediction, which is we're going to be seeing assets top out in late next year, probably around October, as per the 4-year cycle. And so if we do see a regular cycle, all we need to do is look at the calendar, essentially, and see, oh, is it October yet? Oh, it's not. Okay, it's not the top then. And if it is October, well then any sign of weakness in October by a regular TA is likely to be the top, and you'd probably just sell there, right? That's the first scenario, and that's a very easy scenario, and that's what it was like last cycle, and that's what it was like in 2017 as well. And before that point, we didn't have the trends available. So that's how the last 2 cycles have gone. Hopefully we see that again. It's very, very easy, very, very predictable, not very complex at all. But there is a scenario, of course, that we don't see a regular 4-year cycle, in which case we need to find the top in alternative ways. Now, I could list off a bunch of different ways in which we might do this. I have done so in the past. I'm not going to do that right now. Various indicators. But what I will say is this. Fundamentally, if we do not have cyclical evidence to determine when the top is, any sign of weakness is not really confirmed to be the top until we actually see a macro breakdown. So without the cyclical theories there in place to tell us, hey, we're expecting tops around this point in time, therefore be cautious. Without those things, if we don't see that, we just have to get down to the crux of macro TA, right? Macro decisions require macro confirmations. If those macro confirmations are not going to come via the cyclical trends, then they're going to have to come by the price chart, and therefore, in order to see a structure of weakness as something that could be an actual market top, we would simply need to see macro breakdowns. What is a macro breakdown? A macro breakdown is a breakdown from a structure like this. So this is a descending channel formation that has formed since the 73K current top. If this whole thing broke down, that would be a macro breakdown. From that point, we will have lost every single indicator in between. And upon the breakdown, it would be very clear that that was the market top, okay? So unfortunately, if we don't have the cycles on our side, it's very difficult actually to mark the precise top, because if we don't know when we're going to top, any weakness could be seen as a potential top. And in order to validate a potential top as a real top, you need to see the breakdowns for that validation to occur. So let's just hope we see a regular cyclical top, because that's the only way in which we're going to be able to cleanly get out of the market. In the second scenario, in which we don't have a clean way to get out of the market, it might be best just to cut your profits along the way, so that if the top does come and you do get caught slightly off guard, at least you've taken a pool of profits. So ideally, what I'm saying essentially is, if we don't see a regular cyclical top, it's going to be a little bit hard. We will be able to do it, but we just have to wait for more confirmations, like a macro breakdown. And the indicators, you might think, well, what about the indicators? What about things like pi cycle top theory? Well, guys, those have all worked within the bounds of the regular cycle theories. Who's to say they will work if we break the cycle theories? That's the problem with that. So the only thing we really have for full confirmation is macro breakdowns. And with macro breakdowns, unfortunately, you're just going to have to, you're going to be waiting for a while, and you're only going to be able to sell a little bit after the top. So, I would say DCAing on the way up would be your best bet if there was evidence that we were deviating from cyclical theories. I don't think right now there is a massive amount of evidence of that. There was. Right now we're reconnecting to them, but this has been a long-winded answer. Let's just hope for a regular cyclical top. Next question. Do I think we're approaching an altcoin season? The long answer to this question was yesterday's video. The short answer, I'll give it to you right now. Probably, but there's not enough evidence right now to dive headfirst into altcoins. Bitcoin's looking good. It hasn't broken upwards yet. Okay, so two different points there. Bitcoin is looking good, but it hasn't broken upwards yet. And altcoin season only occurs when Bitcoin is in a rapid bull market. We're not quite there yet. We've seen the first leg, but this 6-month consolidation is not exactly reassuring, okay? And if we see the second leg, that's when we can start getting interested in altcoins, because it's only within that second leg, if history is anything to stand by, it's only within that second leg, it's only within the leg that takes Bitcoin definitively above the all-time high region, that the greed starts to return to the market and that Bitcoin dominance starts to tank. And when Bitcoin dominance starts to tank and Ethereum BTC starts to bounce, that's when we see an altcoin season trigger, and that's when altcoins become viable investments, as in contrast to Bitcoin. That's when altcoins start outperforming Bitcoin. Now, is it likely we've seen the start of the altcoin season, but we just don't know it yet? It's possible, but again, it's not validated. It's not something we can validate, right? And what do I mean by that? Well, if we look at the weekly chart RSI and the Bitcoin dominance chart, we have reached the top. There is resistance there, but we haven't broken down from the structure as a whole. So again, it's like that could be the top. That could be Bitcoin dominance's top. We could be technically in an unmarked altcoin season, but it's only validated when we actually break downwards. Until then, it's just a guess. Same with Ethereum BTC. We've bounced on support. That could be the bottom, and therefore Ethereum could start outperforming Bitcoin from here. But until we actually make that bounce into a new upwards trend and mark the bottom itself, instead of just being in what could be a dead cat bounce, it's not validated. So, do I think we'll see an altcoin season soon? I think it's likely. If Bitcoin breaks upwards past all-time highs, an altcoin season, in my view, is 95% chance going to happen. Like, it's very unlikely that we see a bull market with Bitcoin without altcoins going up. That would be completely abnormal. If Bitcoin breaks all-time highs, we will see an altcoin season. But based on everything I know about TA, the altcoin season itself will only really start after Bitcoin breaks all-time highs. Until then, we're in a Bitcoin-dominated market because people aren't greedy yet, right? Altcoins go up when people get greedy. And people don't get greedy without Bitcoin going up first. Bitcoin's the first mover. Always, it's the leader of the market. So that's, I suppose, my short-winded answer to the question. But my more long-winded answer, I did a 15, 16-minute video on it yesterday. So if you're interested, go ahead and check that out. Can you look into the S&P 500's RSI? It's showing bearish divergence. Okay, so a lot of people get concerned about this kind of thing with the S&P 500. They say, look, it's a bearish divergence. There was a high here, for example, a high here and a high here. And on the RSI, we're seeing lower highs each time. And they're saying that the S&P 500 is going to roll over. That's going to drag markets down. Now, that could happen, but it would happen for different reasons, okay? The RSI on the S&P 500 is notoriously unreliable. And the reason being, and let's just show some examples. I mean, if all we got to do is just scroll back to literally any point of the last decade, last few decades, let's say, and all this time, look at this divergence right here, straight downwards, straight upwards, okay? Straight downwards, straight upwards, each time, straight downwards, straight upwards. The RSI on the S&P is not reliable. Straight downwards, straight upwards on the price. It happens all the time, bullish divergences, bearish divergences. The reason being is because the S&P 500 it's fake. It's fake. And what do I mean by that? Well, I mean, if we look at the S&P 500, adjusted for the money supply, which is what this chart is right here. So adjusted for the money supply, this is the S&P 500. If the money supply never changed, the S&P 500 would have been in the same place in 2001 that it was in 2023, right? The S&P 500 did not move in actual value if we're taking out the money supply changes in basically 21 years, okay? It only moves up because of the money supply. It only really moves up because of quantitative easing and inflation. There's obviously many other factors involved in that, and that's a very big oversimplification. But the point is, the S&P 500 and TA done around the S&P 500 is always going to be, to a degree, unreliable due to these external factors that do not affect something like Bitcoin, which is an asset that is, for the most part, not really very inflationary at all. Oversimplification. But very much true. And even if we're ignoring the money supply chart, even if we just cross that out of our minds, all we need to do is look historically at what these bearish RSI divergences have done to realize they haven't done very much. So TA as a whole is not really that important on the S&P. Again, oversimplification, but it does have some basis in truth, and let alone the RSI. Quick little break here, guys. I do trading signals posted 4 times a week on Telegram with a 78.39% win rate on those trading signals, and that's over the course of 2 years. So all of the trading results, I don't hide my track record. It's all publicly available there in that PDF document. You can check it out, 78% win rate on those trading signals posted 4 times a week directly to you on Telegram. On top of that, if you sign up for a VIP membership, you're getting access until April next year. And on top of that, you're getting access to a group chat with 115 other VIP members where we discuss the market 24/7. Very useful stuff being posted in that group chat. So check out VIP if you're interested in that. Let's get back into the content. Right, next question. Please provide some information on the DXY. How does it affect the price of Bitcoin? Let's do that. What is the DXY? The DXY is basically a chart that measures the strength of the US dollar in relation to other currencies. That means that when this chart goes down, the US dollar is decreasing in value in relation to other currencies. That happens during quantitative easing. That happens during money printing. Okay, more money is brought into the economy. It decreases the value of existing money, and therefore the value of the existing money goes down. And that, obviously, if we're relating that back to the first question we answered today, quantitative easing increases the price of assets. So it brings asset values up in dollar value, meaning that when the DXY goes down, that is good for assets, or it lines up with assets doing good. When it goes up, that is bad for assets, or at least it lines up with assets doing bad. This is very clear because look at 2017 right here. What was 2017, guys? 2017 was Bitcoin's bull market. 2018, 2019 right here, that was Bitcoin's bear market. 2021, 2020, that was Bitcoin's bull market. 2022, Bitcoin's bear market. Very, very clear. When did it top out? It topped out in October 2022. What was that? That was the bottom for Bitcoin. It started going downwards and Bitcoin started going upwards. So this chart right here is reverse correlated to Bitcoin. We need it to go down, right? If it goes upwards, Bitcoin goes downwards, assets go downwards. They're not necessarily connected, but they are correlated, okay? So looking at this chart right now, we see it's on major support. It's on support stemming backwards from 2015, right? So very, very long-term support, almost 10 years old. And essentially, in order for Bitcoin to be in the clear, this chart needs to break down because we know that Bitcoin goes upwards when this chart is going downwards. And the fact that it's on support means there's a threat of it bouncing, which means Bitcoin is not out of the woods yet. So we need to see the DXY break down fully from this support zone in order to be fully bullish on assets, which is another reason why I'm not really too interested in altcoin buying right now, because I understand the risk of Bitcoin buying to begin with. Bitcoin buying is not guaranteed to be profitable because we haven't even seen a breakdown on the S&P, on the DXY. And we haven't even got full clear macro confirmation via Bitcoin itself breaking all-time highs yet. We're still in the same macro consolidation phase. I am leaning bullish, but any excessive risk here is just not justified yet. When these macro indicators trigger clearly that the market looks good, like the DXY, then we can start jumping on board with aggressive positioning. But right now, it's just not the time to do it, in my view. This is an interesting question. Loved your analysis of expected Bitcoin top at 130K. Could you do a similar analysis of Ethereum and what price would Ethereum hit? Now, first thing, just a major disclaimer. I do not predict a Bitcoin top at 130,000 in this bull market. That's simply not true. Okay, I made an observation of a trend that would bring Bitcoin to 130K. It's a highly speculative trend. It could break, it could not be reached. If I had to guess, right? If I had to guess, given that the 4-year cycle would be intact, which is not a given, it's actually a big question, then 130K would be my best guess. But even under those specific circumstances where a lot is being granted to me, I wouldn't be confident in it. But let's just assume, let's just take a wild assumption here and say that Bitcoin is going to 130,000 in this bull market, and we're going to see a regular cycle. It's going to top out late next year. Therefore, under those specific circumstances, which are very vague, very hard to verify at this point, where would Ethereum go? Or even then, we wouldn't even be able to say where Ethereum would go, because the thing about Ethereum is the only reason we're able to have any sort of predictive capabilities on Bitcoin is because of the historical data that exists for it. We do not have the same historical data for Ethereum. We simply do not, right? We look back, Ethereum created back here 2015. We don't have really any data that's relevant from 2015 to 2017 because Ethereum was simply too small, okay? So any data we could take from 2015, 2016, even into 2017 is irrelevant. Ethereum was too small. It was a tiny asset. It was not a market mover. It's irrelevant data, okay? The market cap was tiny. In late 2017, we start getting data that maybe is relevant because that's when Ethereum starts establishing itself as the leader of the altcoins, especially with the bull market top there, very clearly marking the top 4 altcoins and acting very clearly in correlation to Bitcoin. It only really starts being relevant in late 2017, which means we have no data from the actual bull market itself from 2017. So the only usable data we have on Ethereum is one bull market worth of data. And as you know, you need 3 data points in order to create any sort of mathematical trend. So 2 data points would be a stretch, and 1 data point is just non-existent amount of data. You don't have any data really at all. You have the baby steps of data that could be to come. So the only form of analysis I can do is basically measure how high Ethereum went. It went up, about 6,000%, let's say, or 5,800%. Compare it to Bitcoin. Bitcoin went up from the bear market low about, let's say 2,100%. Let's just say, roughly it went up, 60, I don't even know, what would it be? Let me do the math. Close to 150% more than Bitcoin. So Ethereum in the last cycle went up close to 150% more than Bitcoin. If Bitcoin was going to go to 130,000, that would mean Bitcoin would go from, let's say 15,000 to about 130,000, which is 770%. And Ethereum, if we're assuming this very speculative trend, would go 150% higher, 1.5 times higher than 770, which would be, off the top of my head, about 1,100, maybe 1,200, okay? So therefore, Ethereum would rise, let's say 1,200%, let's just be optimistic. From its low, that would bring it to around, let's say, 11,000. So Ethereum would go to around 11,000 if Bitcoin went to 130,000. Highly speculative, but it is a rough guideline at the least. So I suppose that's useful enough, but I certainly wouldn't be making any major decisions based on it. Next question. Reasons why a bull market will happen and reasons why a bear market will happen. So let's argue for both sides here and just give the justifications and the fundamental point of view for both sides as I see it. For the bulls, right? The people who believe we're going to see a bull market. The argument is essentially the cyclical trends that have been intact for decades in many cases on traditional markets and on Bitcoin are going to remain intact. The status quo is going to be maintained. We're going to see a regular bull market. Bitcoin's going to go upwards as per the 4-year cycle. It doesn't even really need to top out, as per the 4-year cycle. It just has to follow it for now, and the price needs to rise for now. So basically, Bitcoin, traditional markets in general, are following their regular cycles. For now, that is the case. They're not broken yet. Therefore, we will continue to do so, and therefore the market will be dragged to the upside, okay? The opposing point of view, the bear's point of view, the bear market point of view is the cyclical trends will not be maintained. They are imminently going to break, and they're going to break because of unemployment spiking to the upside, which has not happened yet, but it's rounding out. It could spike to the upside. If unemployment spikes to the upside, it will lead to mass fear and recession, okay? On top of this, the bears point to things like interest rates dragging down or seemingly dragging down markets on the last two occasions of them being cut in 2008 and also in 2001. In doing that, they ignore various data points, and I can go into that. But basically, the bears are saying that the cyclical trends are screwed because of a pending recession, and the bulls are saying, no, we're not going to see a recession yet. The trends are still intact. Everything's fine for now. Those are the two arguments. And so you got to assess which one has more valid data behind it. And in my view, I'm very much a person who takes the trend is your friend until it ends point of view. Until I see actual evidence for the bearish point of view, I'm not going to jump on the bandwagon, right? I think the bears right now are acting against the 101 tenets of TA, which is do not make decisions without confirmations. They've got these speculative theories. They've got predictions. They think things are going to happen. They think everything's going to change here, but there's no actual evidence of that happening yet. There's just a few threats that are lurking that haven't actually sparked up into actual danger yet. Okay, so that's kind of the where I stand on that. I think that the bullish case right now is more logical, just because we haven't actually seen any damage done to these trends yet. Just seen some vague discrepancies. We've got some vague threats going on, but nothing actually is actively breaking. Nothing's actively broken, right? So those are the two arguments, and I hope I explained that well enough. Voice is getting a little bit tired now, so let's move on to the next question, and then we'll wrap up. We'll do two more questions. Do you believe that trading is still viable for the average person, or are trading bots and algorithms too intense for us to overcome? No, trading is still viable. Okay, let's be very clear here. Trading bots are a scam. They're a scam. They do not work in the vast majority of cases. If they did work, they would overcome the market so quickly you would not believe it. And then as soon as they overcame the market, they would stop working, because the trading bots are programmed based on TA, okay? TA is based on price action. Price action is basically just human emotion painted on a chart. So the trading bots are a product of human emotion, right? They only work because of human emotion if they did work, which they don't, okay? And if humans exited the market, there'd be no more human emotion. And so it'd only be trading bots trading the market, and therefore the algorithms would stop working and humans would return. It's impossible to get to a point in which trading bots and algorithms have a significant stake in where the market goes, all right? And they manipulate TA, or they make the charts not make sense anymore, they make it not tradable. The charts will always be tradable because it just cannot be any other way. Again, if the charts got to the point where they weren't tradable, humans would step away from the charts, and the thing that made them not tradable, the trading bots, would stop working because there's no humans in the charts anymore. And the data is based on human emotion, human sentiment. Final question. Let's say you got a very good entry on an altcoin with 10x leverage. How long should you hold that altcoin, right? Given market conditions are right. Can you just hold it forever is essentially what he's asking. No, you can't just hold it forever. There is a time limit through which you want to hold leverage positions. And the time limit, in my view, is not very long. You want to be getting in and out, okay, within a week for the most part. And the reason being is because, yes, you're paying these funding rate fees, but on top of that, you're also adding risk to your position via having the money on the exchange to begin with. So having the money on the exchange is the risk, because obviously the exchange can get hacked. The exchange itself can scam you, like in the case of FTX. But more importantly, and even more potently risky, is the idea or the reality of exchange scam wicks, which happen all the time, right? So exchanges can see massive discrepancies in price action. If the upside or downside happens all the time on many exchanges, and they hide it in hindsight, they cover it up, and your stop losses can get hit, your take profits can get triggered, and it can happen without the price actually moving in reality. On top of that, there's the risk of your stop loss on a leverage position, which is very, very important, not actually being triggered for various reasons on the exchange, liquidity, whatever it may be. So there's just a bunch of exchange risks, which means you don't really want to be holding for too long leverage positions. They want to be something you get in and out of for the most part, due to the exchange risks and due to the funding rates as a whole. I can't give you a specific time frame. It depends on this position itself. But I can tell you this: I've never held. Sorry, I can't talk right now. I've been talking for too long. I've never held a leverage position for more than a few weeks. That's me personally. So guys, that's the video. Thank you for watching. The BitUnix and BingX exchanges, again, the referred exchanges for this YouTube channel. Use my referral links down below to sign up for a 15% trading fee discount. They are both global non-KYC. They're both very low in trading fees. Check them out if you're interested. Also check out the Crypto Academy. Let me reload the page right here. You can see the Become a Trader course teaching you how to trade. It's a self-directed 10-unit course, about 20 to 30 hours of content. We made it in 2022, myself and Megawell Crypto. If you're interested in learning how to trade, that's where you can do it. It's on sale right now as well, so that's an added bonus for a limited time. And I'll mention as well, guys, my second channel, JS Quinn. I post podcast content on there. If you're interested in any of those titles, I just did a podcast on free will last week. If you're interested in that kind of content, check it out. I really appreciate it. And again, the VIP group on Telegram, altcoin trading signals. You know the drill, guys. Check it out if you're interested. Thank you for watching, guys. Hope you enjoyed. I'll catch you soon.